When it comes to doing our taxes, outside of claiming tax credits and above-the-line deductions, another crucial dilemma many of us face is this: to itemize or to not itemize. Should we take the standard deduction, or should we try to maximize the itemized deductions? So in the line of itemization, in today's video, we're going to review the top 10 itemized deductions you should be aware of so you can make the best financial decision when it comes to doing your taxes. Hi, if you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. But before we get to our list, let me briefly cover why understanding your below the line, or better known as itemized deductions, is very important when doing your taxes. Also, please note I'm not an accountant and this is not tax advice, just information to help you increase your overall tax knowledge. When it comes to tax deductions, there are two main buckets: above the line deductions, aka adjustments to income, and below the line deductions, aka itemized. And these deductions legally lower the income that we're taxed on, which in turn lowers our tax bill. The first layer of deductions, adjustments to income, happen before we get to the itemized versus standard deduction decision. These deductions are subtracted from our gross income to determine our adjusted gross income. If you'd like to learn more about these deductions, I have a whole video where I go over the 10 most common above-the-line deductions, so please check out that video here. However, once you maximize these above-the-line deductions, you now reach the below-the-line deductions. Below-the-line deductions are qualified expenses that are subtracted from our adjusted gross income to help determine our final taxable income. The IRS lets you take either the standard deduction or itemized deduction. If we have a lot of itemized deductions, meaning the total exceeds the standard deduction for our filing status, then taking the itemized deduction makes sense. However, if our itemized deductions does not add up to greater than the standard deduction, then it makes greater sense to just take the standard deduction. For example, the 2022 standard deduction is $12,950 for single filers and those married filing separately, $25,900 for joint filers, and $19,400 for the heads of household. The 2023 standard deduction will increase to $13,850 for single filers and those married filing separately, $27,700 for joint filers, and $20,800 for the heads of household. If your state and local taxes, including real estate, property, income, and sales tax, plus your mortgage interest, charitable donation, and other itemized deductions that we'll cover in this video, do not add up to more than the standardized deduction, it is likely better to take the standard deduction versus itemized. Said another way, to make the below-the-line deductions worthwhile, you want the combination of these deductions to be more than the standard deduction. Alright, enough belaboring that point. Let's get into the top 10 below the line, or better known as itemized deductions, to see if itemizing is worthwhile in your situation. The first itemized deduction you want to be aware of is deductions for state and local income taxes. But before I talk about this specifically, let me talk briefly about deductible taxes overall. Generally, there are 4 types of deductible non-business taxes: state, local, and foreign income taxes, state and local general sales tax, state and local real estate taxes, and state and local personal property taxes. We'll discuss real estate taxes and personal property tax in number 2 and 3, but I want to talk about state and local income taxes and sales tax here first. When it comes to deducting these taxes, you can elect to deduct state and local general sales tax or state and local income taxes, but you can't deduct both. People who live in a state that does not impose income tax often benefit most from choosing the sales tax deduction option. However, you could also be better off deducting sales tax instead of income tax if you made a large purchase during the year and your total sales payment exceeds those of state income tax. You can use either the actual sales taxes you paid or the IRS optional sales tax tables. If you opt for deducting state and local income tax, you can find them in your Form W-2, wages and tax statement, given they're automatically withheld from our wages during the year. With that said, the total deduction of all non-business taxes, state and local income, sales, and property taxes, also known as SALT deduction, is limited to combined total deduction of $10,000. We want to be mindful of this $10,000 number as we add up all the tax-related deductions. For example, if the total sales tax we paid this year exceeds $10,000 because we made a ridiculously large purchase, there may not be a need to look at real estate tax or personal property tax. With that said, that's probably not the case for many of us, so let's move on to number 2. The second itemized deduction we want to be aware of is real estate tax, or sometimes called simply property tax. Most state and local tax authorities calculate property taxes based on the value of the homes located within their areas. If you pay your real estate taxes through an escrow account, look at the real estate taxes shown on Form 1098 or the year-end tax summary your lender provided. If your real estate taxes are not paid through an escrow account, review your property tax bill online and add up what you paid. But be careful not to deduct certain items on your real estate property tax bill that may look like taxes, but are actually miscellaneous charges that are not deductible. These can be fees for water or trash service, or sometimes assessments for local benefits such as a charge to construct a sidewalk outside your house. The third itemized deduction you'll be aware of is deduction for personal property tax. A common one for many people is our vehicle registration fee. Annual car registration fees may be deductible on our federal income taxes as part of local personal property tax. Of course, only the portion of the registration fee that is charged based on the vehicle's value can be generally claimed as a deduction. Depending on our state, it might not be apparent whether a portion of our car registration is value-based or how to identify what portion of the fee qualifies for the deduction. For instance, in California where I live, a value-based portion is identified on the car owner's billing statement as a vehicle license fee and is specifically labeled as tax deductible. Deductible car fees go on the line for state and local personal property taxes. And again, as stated earlier, starting in 2018 and until 2025, our deduction of state and local income, sales, and property taxes, also called SALT, is limited to a combined total deduction of $10,000. That means that even if the combined total of our sales, real estate tax, and personal property tax amounts to $15,000, we can only deduct $10,000 maximum. So before you go out and chase down all vehicle registration fees, you might want to see if you're already at the $10,000 mark with all the taxes we discussed so far. The number 4 itemized deduction we want to be aware of is deduction for mortgage interest. Home mortgage interest is deductible on the first $750,000 in loans. Each year, mortgage lenders mail Form 1098 to borrowers, which details the amount of deductible interest and points that we've paid over the past year. Taxpayers who bought or refinanced home during the year can also deduct the points they paid within certain guidelines. If the mortgage originated before December 16, 2017, then a higher limitation of $1 million applies. The higher limit still applies if you refinance the older mortgage as long as the loan amount remains the same. The number 5 itemized deduction we want to be aware of is the deduction for home equity loan interest. But be aware that the home equity loan interest is only deductible provided that the borrowed funds are used to buy, build, or substantially improve the home that secures the loan. For example, we cannot take the deduction if we're using the home equity money to pay for personal expenditures, like paying off credit cards or even just sitting in the bank as an emergency fund. The renovation has to be made on the property in which you're taking out the home equity loan. If we use a loan on our primary residence to renovate our second vacation home, that doesn't count. The number 6 itemized deduction you'll be aware of is deduction for charitable contributions. Any donation made to a qualified charity is deductible within certain limitations. For cash contributions between 2018 and 2025, the amount that can be deducted is limited to no more than 60% of the taxpayer's AGI, the adjusted gross income. So add up all the money you donated to food banks, relief funds, religious organizations, and other nonprofits. If you donated clothing, furniture, and other household items, you can deduct those as well. Of course, you need to know the value of the items you donated. Keep a record of the items you donated so you can estimate the price based on how much a local thrift store charges for a similar item. I like cleaning out my garage, so I make pretty frequent trips to our Goodwill. But when I do, I always make sure to spend 10 minutes afterward jotting down the items I donated so I'm not relying on my memory a year later. And I always make sure to get a receipt. You always want to have good records to back up all your charitable donations. A written acknowledgement or a receipt should suffice. The number 7 itemized deduction you'll be aware of is deduction for medical expenses. This is an interesting one because although medical expenses are deductible, in reality, few taxpayers actually get to deduct them. That's because you can only deduct costs that exceed 7.5% of your adjusted gross income in 2022. For example, if your adjusted gross income is $100,000, 7.5% or $7,500 out-of-pocket medical expenses are not deductible. It is only when you exceed that 75% of AGI that you start to see the benefit. So based on the earlier example, if your annual medical expenses is $10,000, then you can deduct $2,500. $10,000 minus $7,500. If you have a year where you have a lot of medical expenses, this could be a good deductible to have in your pocket. A tip to save time on this is this. Multiply your estimated adjusted gross income by 7.5% and consider whether your out-of-pocket costs will likely exceed this amount before you start chasing down all your doctor bills and receipts. The number 8 itemized deduction you want to be aware of is deduction for long-term care insurance premiums. There are a lot of nuances with this one, so let me explain. 1, because long-term care premiums are included as part of medical expenses, the amount that you can deduct are expenses that exceed 7.5% of adjusted gross income. In addition, there are also limits on the amount of annual premiums you can deduct based on your age. For example, in the tax year 2022, if you're between the ages of 41 and 50, the amount allowed as medical expense caps at $850. If you're between 51 and 60, it caps at $1,690. Lastly, if you're self-employed, you have another unique situation. You may be eligible to deduct your long-term care insurance premium on your tax return without itemizing at all. Long-term care premiums are a tricky one, so if you're paying premiums right now and want to see if it's worthwhile deducting, you might want to work with an accountant on this one. The number 9 itemized deduction you want to be aware of is deductions for casualty losses due to a federally declared disaster. If you suffer property damage due to a federally declared disaster, you might be able to claim a casualty loss deduction. There are, of course, specific criteria you have to meet in order to qualify. For example, the federal government must declare the region a disaster area. Where I live, fire is the most common natural disaster. So if you want to confirm if the recent disaster meets the criteria, you can actually go to Federal Emergency Management Agency, FEMA's website, and actually search for a list of disasters that occurred near your area. I know this is a pretty rare situation, but if you do find yourself in it, do your research so you aren't leaving money on the table. The number 10 itemized deduction you want to be aware of is, to be honest, a deduction you likely don't want to have, and that is deduction for gambling loss. In gambling, losses and expenses are deductible only to the extent of gambling winnings. So spending $100 on lottery tickets isn't deductible unless you win and report at least $100 too. Now, gambling for fun and doing it occasionally is okay. However, be careful not to let it consume you. It's like playing with fire, so you want to be very careful with this one. That's it, guys. It's a lot we covered, so thank you for staying with me throughout this video. If you'd like to continually expand your knowledge about taxes, then I recommend checking out the 10 best above-the-line tax deductions video here. Thank you again. Until next time, all the best.